Thank you.
Yeah, so I miss those days. I just need to, I'm gonna, like I said, adopt a kid.
It's all good in theory until the nuts and bolts come into play. Logistics. Oh my God.
Yeah, yeah, I get it. Hey, everyone, thanks for joining us. We'll get started here in 30 seconds or so. We're just gonna let some people come in. Thanks for joining us today. Share with us your kid situation in your household. We've been talking about in the chat how many we have and what they're doing. So if you want to share the craziness of starting back to school right now for people,
Yes,
share us.
please share your most expensive, ridiculous purchase with back to school. I'd like to know that I'm not alone.
That is one thing that is so true that I can't remember where I saw this statistic, not anything related to mortgage, but the cost of getting a kid, the supplies that they need, and getting them back to school. I was just shocked at how much it was. It's like, what are they buying? Oh, there you go, Ashley. $800 spend between clothes, shoes, and supplies. Three kids, three different schools. Yeah.
It's brutal.
Yeah.
All the kids, at least my son's age now, 2.5, they all have Yeti water bottles. So of course my kid can't not have a yet monogram Yeti water bottle. And we need three. And I'm like, this is just like, what? What shouldn't it be 50 cents? I don't even want to know what it costs.
It's funny because my ex is works in a school district, and he was talking about in our school district the thing of the year. They haven't started back to school yet, so it was at the end of last year. Is the Stanley Cups?
Oh yeah.
Who doesn't have? He said I felt bad for the kids that didn't have the Stanley Cups because, like, it was like a status symbol almost, and he's in an elementary school.
That's
Uh,
ridiculous. And like the most beautiful case study in marketing and marketing representation I've ever seen. That cup's been around forever. It is just a cheap cup. How much do they charge? Like 40. I remember going through Target.
$40.
Someone, yeah, there's a sign that says like, only one per customer, like two if you're lucky. What is this?
Yeah. Yeah,
I'm in the
it
wrong
is
business.
crazy. All right. Well, we're going to get started now. If you just hopped into our discussion about kids going back to school, um, the cost of kids going back to school, how many kids you have. So you'll see some comments in the chat there about the family membership of the TMC family in the chat. Feel free to join in there if you would like. But this is the last week in mortgage today. I'm Faith Howard Mooney, the SVP of Member Engagement here at the Mortgage Collaborative. I have with me today Jared Pearlman, who is the Chief Operating Officer of Choice Mortgage. He also is somebody that still originates, which I always love talking to people that are kind of boots on the ground as well. Thank you for doing this with me, Jared.
Yeah, absolutely.
Um, you want to share a little bit, if you could, about who Choice Mortgage is, so people kind of get your frame of reference.
Yeah. So Choice Mortgage Group, we have a fairly unique story. I'll kind of give the elevator pitch version. The company originated in the mid 90s as kind of a different entity, really a mom and pop broker shop, grew a little bit and kind of grew a little too big for its own foundation. I started in the business shortly after grad school, didn't actually finish grad school. Had to get out of there to go into the business at 22 years old. Started originating, helped grow a team. That team got to about 70 to 80% of the overall business in the company back in 2019. And we realized, first we tried to buy the company, realized it wasn't, you couldn't purchase it. Like you couldn't value it. The books were all a mess, as a lot of small mom and pop shops are. And so we kind of got this opportunity to take over the operations of the company and have a really great proving ground through 2019, 2020, and 2021, really building the staff, building the structure, building everything there. And come beginning of 22, about the worst time in the world to do it, we were able to part ways with the owner of that company. He stayed as a one-man broker shop. We took the entire operational team, 90% of the sales staff, took all the technology that we've been working on, kind of plopped it right down the street. We're only like 3 miles away from the other building. Changed our name from Choice Mortgage to Choice Mortgage Group, so big difference, and just kind of kept going. So we have this, we have this really long history and culture with a relatively new company, which is always an
Right.
interesting story to tell people. And we're located here in South Florida. Thank God for that. At least in 2022, it was one of the strong markets. We're currently in 15 states, going into 16. We have some loan officers in Texas, New Jersey, working on the Northeast and some other places in the country right now in terms of our expansion.
Yeah, it's such a good story. I'm always amazed by, I think that the people that, come into a market, number one, you never know what it's going to be. I mean, we all know that by now. We're all in mortgage. It goes up and down and has, in the past had more traditional cycles. This has been a lot different than what we've seen in the past. But I feel like people that do that are people that have that entrepreneurial spirit. They're willing to do a lot of different things, try things that are different. So I'm kind of interested in like just hearing from you. Number one, you are in Florida. So like what are you seeing out there? What are your team seeing, whether it's in Florida or one of your other states, related to like what kinds of deals are going on now? Is it all, first time home buyers trying to get into home? What are you seeing in the marketplace right now?
Yeah, so Florida's unique. Well, I think it's unique. I obviously don't know every market, as well as I know my home market, born and raised here. But all the new construction, even the existing homes are insanely expensive. And I say that coming from, I grew up in North Miami Beach. I think my dad bought the house I grew up in. I mean, this is like a 3,000 square foot ranch style house. I want to say he paid like $81,000 in '88, and I saw it just sold for 2.6 million. And I did not grow up in a $2.6 million house. I'm like, I can't even fathom it. So, it's a little bit of a unique market there. And, I'm sure as everybody listening knows, in our space, there's not a whole lot of money to be made. And we're really not that competitive in the jumbo market. We just can't compete with private wealth where they're going to go, to next to nothing or below nothing on the deal. So, traditionally, my business personally, like you said, I still originate, and our company business, we are a agency govy shop. But I don't know when it was 4 or 5 years ago, whenever this non-QM, piece of the business started rolling out, we really took to it, especially down here. And so a long way to me answer your question, like we're still doing, strong govy and agency business, but we're doing a lot more non-QM. One of my big pushes over the last year has been to remove any need to broker anything, however weird, and either do that as a non-delegated correspondent or a delegated correspondent lender. There's a lot less rate sensitivity and therefore margin sensitivity in that space. And there's also a lot bigger deals. So we've been seeing a really good chunk. It's gone from, in 2022, it was only about 10% of our business last year. It was about 15%. And this year, non-QM represents about 25% of the units and about 35% of the volume overall. And it's really profitable volume if you know how to do it. So that's where the deals are. And that's where we try and coach up our team to go look for them.
Yeah. Have you seen, I'm just curious about this because I come from the old days where, there was pre 2007, where there was a lot of stuff going on in that world where, they called them B and C paper and those types of things. So the terminology was a little bit different. But have you seen in those? I mean, obviously they're priced differently because maybe there's a different type of risk associated with them. Have
Mm-hmm.
you seen any downside in that increase in the business that you've had from like default, maybe early payoff? Is there anything else when you're working in that business that you've had to consider that equates to more risk for you? Do you
Well, I mean,
think?
we're not servicing it, so the default, as long as it's
So
not
you're
within
selling,
the
yeah.
time frame, has not been a problem. EPO isn't really a problem either, especially with investors. We do a lot of DSCR. You generally want to put a prepayment penalty on it, both for you not having the EPO, and it's just far more attractive to them. There's options without it, but the rates just aren't as attractive. And quite frankly, when you boil it down, it's not a lot of paper that's a 620 or a 580 FICO. It's not a lot
Right.
of that anyway. This is actually like really high quality borrowers that are just their income is a little bit unique.
Yeah.
Or,
Yeah.
the situation is a little bit different. Maybe they've only been self-employed a year. Maybe they're, especially down here, maybe they're a foreign national. Maybe they are, the South Florida special, we like to say, they show that they are below the poverty line in their tax returns, but they pull up to our office in a Maserati. That's my favorite client right there because they know that they're not going to qualify traditionally. They don't even want to show us their tax returns, but their bank statements show hundreds of thousands of dollars coming in. We actually had like a $3 million bank statement refi about 2 weeks ago. I saw it on the board to close and I said something to the loan officer. He goes, "Oh, we have to push it back." I go, "Why? Let's close it today." He goes, undisclosed debt monitoring picked up an inquiry from Lamborghini. I'm like, oh, okay, cool. This guy's buying a Lamborghini right before closing. But we love those clients because, like I said, they're not rate sensitive and therefore they're not margin sensitive.
I love the South Florida special. I love the terminology. I'm always looking for a new term every week when I'm on here. So I absolutely love that you've had it enough that you have a name for it. Um, so in your world, you're probably not maybe dealing with as much like DPA and those types of things just because of the type of borrower that's in your back door? Or do you still have kind of that mix? I mean, you're a Govy, you've done a lot of Govy business. So you have a wide range then in what you're seeing. It could be either end of the spectrum.
We do. And, like you said, I get to wear two hats, two unique hats. I'd say like most nights, it's kind of like this weird dichotomy in me, the struggle of like on a COO side of things, I have to deal with risk and compliance. And then on the other side, I'm still a salesperson at heart. And, I do still go out there. It helps and it hurts. But, we have DPA programs. So I'll tell you from the sales side of things, I have gone into many a real estate office. I have done many a presentation saying that I have a DPA product, and I personally have never sold a DPA loan. I don't think that they're not profitable. The clients are harder. It's a longer sales cycle. It's a more frustrated, realtor partner. So I never found as a salesperson the true value in it for my clientele when I was going after. Now, that's not to say that there aren't plenty of people that have developed a business in it, and a business around it. Excuse me. In fact, I have a loan officer who is based in Texas, and he is the T-Shack guy. T-Shack is the down payment assistance program out of Texas, and it's interesting because he's the T-Shack guy, all he sees is DPA loans, and so we actually had to put a process in place really for him, but it's for everybody. If you're going to do a DPA loan with us, you have to send it in to get reviewed. It gets reviewed by a little committee very quickly. And then at the end, I get the write-up. And quite frankly, my job at the end is to show them the better loan product that makes a lot more sense than the DPA loan, because that LO or any number of LOs don't necessarily have the creativity to move things around or say, hey, if I ask for a 20 basis point exception here and move the rate up here, I can give them a little bit of a lender credit and accomplish the same thing with a significantly better product. And so I think you have a lot of people that get stuck in that world, but it's a tool. I'd say this year, I don't know, 20 DPAs that crossed my desk. We closed 6 of them as DPAs, probably 4 or 5 fell out for other reasons. And another 10, we were just able to find better products.
Yeah. Yeah. I mean, it's like you need to look out for your borrower and find them. That's what you're really paid to do, is be that special consultant that's finding them the right thing that works. I see that Christy Sukamnit happened to also notice the bar in the background as well as your art. So Christy, I was right there with you. That's the first thing that I asked him about when we hopped on today.
They're both from the same guy. My little guy is almost 2.5 now. So the bar had to leave my house. Unfortunately, haven't had a lot of occasion to drink over the last couple of years here at the office. And the art was him when he was about 12 months old, crawling around on the canvas. So
Yeah.
Makes me look sophisticated, but it's really just a mess from a toddler.
Fantastic. Let's talk about a little bit about home construction.
Okay.
And where it's going in the United States right now. So there was an article that was published this week that talked about the 20 largest markets 20 large markets, I guess I should say, in the United States. Not surprising, there are a number of them in California. That didn't surprise me. Arizona didn't surprise me. Vegas was top of the list with 106.9% increase in the value of new residential housing units. There was one at Tampa, St. Petersburg, Clearwater, that was number 19 on the list. What are you, I mean, in some of the markets that you serve, are you seeing new construction to be prevalent? Are you seeing it taper a little? Kind of what is your teams, what have they seen?
Yeah, I mean, it's definitely prevalent. It's absolutely unique to each market. After Florida, our second biggest market served is in Texas in the Houston area, and then Dallas after that. And it's funny because we'll see what new construction looks like there, and you can get quite a nice house for $400,000-$500,000. And
Oh,
here in Boca Raton, the cheapest new construction you're buying is about 2.5 million. Um,
yeah.
but it's prevalent. I mean, listen, we are missing a lot of housing units. I think the last stat I saw was every 10-year period, up to the last 10-year period, we had somewhere between 10 and 12 million housing units put on market, and we undershot that by 5 to 6 million.
Yeah, it's not a new problem. I think a lot of
Uh,
people think it's a new problem. It's just this problem has been going on for a long period of time. And now it's become a huge problem, right?
yeah, and I forgot what the term was, but when I was at secondary conference in New York, I can't even remember who was saying it, but they were saying there's all these families that haven't formed yet because of the problem. There's all these kids living at home later and later and not going out and starting families. And I can tell you as a millennial, like I see that in in people that are my age, that they're not out there having either their first kid, second kid, third kid, buying that next house. But
Right.
to your original question, like, yes, it's huge, and honestly, it needs to pick up. But I don't think that value of new home is quite there. So I honestly anticipate that it's going to taper off sooner than it should. Um, but we need it.
Yeah. Sarah Wood popped in the comments, the death of the starter home. I would
True.
have to agree. I mean, it's like I don't think here, I'm in the Twin Cities, so Minneapolis, St. Paul in the suburbs. And I really don't think there's, I mean, I bought a home, my first home, I bought for 99.9. It's about 2,500 square feet. It has a 385-foot deep yard that's beautiful. It wasn't beautiful when we bought it, but it's beautiful. And it would now sell for about 385 here in the Twin Cities. And it's like a classic starter home. It's beautiful still. It's been very well maintained, but I would never pay $385 for that property. $385,000. I would pay
Yeah.
$385, but not $385,000. And I think that's what we're experiencing in a lot of different markets. It's like they're really, I mean, wages obviously have increased, but have they increased enough to compensate for that difference in housing? So I think it's always interesting. We have a ton of new construction here, but there is not any new construction here that starts with the beginning number is anything less than a 4. And if you're in the 4s, you're in they say mid 4s, but by the time you're done with it, you're in the upper 4s or 5s. And so it's just such a strange thing to me that there's really nothing out there. Now I've seen a lot more signs in yards. I've seen signs in yards, which I've seen
Mhm.
some. For a while there, you didn't see any of that. You didn't see anything listed here, but you're starting to see some of that a little bit more, and them not going down in the matter or having a sold sign on them in a matter of a day. But it makes me wonder, what are people saying the value of that home is? I mean, what are they trying to sell it at?
I think in a lot of markets you had people, selling very high for a short period of time. You had a lot of people leaving the cities during COVID. They needed to get out. They needed to get out of their condos and their apartments, and so you had that. But really, we need to find a way. It's good that you have the sold signs or for sale signs up there. They're still aiming a little too high from what I see, but we need to increase the velocity of the market. Whoever said the death of the starter home, Sarah, it's true. Like, we don't have people leaving their houses as frequently as they did before.
Yeah.
When I started this business, I would say to everybody, hey, you're going to sell in 7 to 8 years on average. I can't say that. I mean,
Yeah.
it's just not true. But we need to find some different ways. Maybe it's tax incentives, maybe it's, homestead incentives in the homestead states, to move that tax portability a little bit more. But something, we got to get that boss.
Yeah. Veronica, thanks for joining us today from Down Payment Resource. Yes, great resource for those people that do need assistance to be able to purchase their starter home. And then I love the comment in there that my starter home has turned into my add-on home. Thanks, Ash. Because I think that's what a lot of people are experiencing. Instead of moving, they're trying to, live with what they have until, I mean, maybe that's just what the market is right now for them, that they want to move up but can't move up. So we're going to stay here and we're going to change it to be what we want it or need it to be
Even the
at
ones
this
who
point in
can
time.
move up, it just doesn't make financial sense when you look at when you're locked in at 2%, when your taxes are based on something that was 3x ago, when your insurance maybe in these markets where people are leaving, especially in Florida, is still stuck in there. How are you going to pay 4 to 5 times as much for 0.5% more comfort? It just doesn't make sense for a lot of people.
Yeah. Yeah. Yeah, Alice, thanks for the comments in there about your house. I think that's what a lot of people are experiencing right now. Um, One of the articles I read this week, I thought it was interesting that it was talking about lenders moving from a defensive position to an offensive position in their business. And it was, talking about things that they are shifting, which I feel like, I mean, we're on calls with our lender members within the TMC family quite often. I feel like our TMC family, maybe they're just way ahead of the curve. I know we have a lot of smart people in our network. I feel like they made this shift some time ago. I feel like if people are shifting some of these things right now, I feel like they're behind maybe what we've seen, or maybe it's just that the news picked it up at this point. But it's things like being done and over with capacity reductions within their teams. I feel like maybe our people in our network were a little bit quicker to start realizing that this wasn't going to recover as quickly as it can, focusing on revenue growth and because they've already done all of the things related to cost cutting within their process, expanding their product offerings, and in dealing with the market a little bit more, and what are we going to have to do to penetrate the markets that we're in and gain more business. I know we've heard some from you guys about some of the things that you've done. Do you feel like everybody should be in that spot already? Because that's kind of how I feel. Or do you feel that there are some people that are kind of lagging behind, not wanting to do some of those things, thinking that there's going to be a big turn that still brings them in more business?
I think if you didn't take the last 2 years to really look at your business, to really decide who you are and who you want to be, and to put whatever those metrics or those key moments are in place for you, then I don't know. Like, I don't know where you are and who you are today. One of the first, we joined TMC, I don't know, maybe it was a year and a half ago, almost 2 years ago. One of the first things that I noticed in a meeting, whatever the first one we did was not a good tone. Everybody was, I mean, it was a Lendersaholics Anonymous meeting. Like, everybody was just saying, why am I in this business? It's terrible. We're losing money. I think I might have gone to the bar at that point. And very shortly thereafter, we made the tough decisions and we cut as deep as we could without changing who we are. I mean, we could have gone back to a 2 to 5 man broker shop and been extremely profitable, but we never would have been a real business, a real lender again. And then we started revenue growth activities then a year and a half ago. And I noticed the tenor of the meetings changed to that. Yes, you can find some different places to save money here and there, but if you haven't been focusing on that for the last year, then you're already behind.
Yeah. Yeah, that's kind of what I thought when I read it. I thought, well, maybe it's just something that they picked up because my view on that was just a little bit different. In that, I think most of the lender members in our network are have been ahead of that curve. It's not a new thing. I'm going to do a quick plug for those of you that are attending our conference in Denver. We do something called the $100,000 hour. We've done it. I think this is our fourth conference, maybe, where initially the first one, which would have been more than 2 years ago, we were focusing on cost savings ideas. That's how the idea came up. What are people doing within their business to cut some of their expenses? We've flipped it over this year to add $100,000 to your bottom line from ideas that are in this session. We are focusing on revenue generation. I'm sure there are some cost cutting ideas that will come up in there of things that people have found that they're willing to share with everyone else in the network. But we did that flip to focus more on where are people generating more revenue? How are you progressing that through your business? So if you're joining us in Denver, we didn't bump any other sessions up against that one. So please make sure you come into the room for that session. And Sarah Wood so graciously just posted our conference agenda in there. If you haven't decided if you're joining us yet, there's still time. So still join us if you want to. It's going to be a really great conference. Oh, Mark Grinnell, how sweet. Who's not joining us in Denver? It's crazy if you're not joining. Appreciate that, Mark, and glad that we will be seeing you there for sure. So moving on, I think one of the things that there was something in National Mortgage News that I picked up on this last week, and it was, what should 2025 housing finance agenda be? Not wanting to get into the political piece component of this at all. But there were some things in there that, like, one of the things was still reforming Fannie and Freddie. I don't know where that will go. I think that has been talked about for such a long time that I'm not sure where that one is going to go. I'm not sure that I have a decent opinion on that particular thing. I don't know if you do, but I mean, does it matter who's in office? What happens with that one? Is that part of the equation?
I don't think I mean, I know, I believe the last thing I saw, not to get political, Harris was really pushing, a $25,000 first-time home buyer credit. I don't think any of it is going to change a whole lot. I don't think any of it would go through. As far as Fannie and Freddie, I mean, I do believe private enterprise is probably more apt to, find the niches in the market. I know Freddie just went through the first time they went through this auditing process or approval process was trying to get seconds out there, and they're still not out. Any large aggregator that wanted to drop seconds on their plate, and there have been a few, have called up, people like me and said, do you want this? Yes. And 2 weeks later, guidelines are out. And so I do think privatizing them would really open up the market and open up something, more, not really unique, but something more, general for us to sell as a community, whether it be HELOCs, closed-end seconds, or some general non-QM products. But I think that'd probably be a boon to us.
Yeah. Well, and you stated it, just like anything else, if it does happen, it's probably a long ways away from implementation. Any of that, all of that stuff just takes a lot of time. New York Governor Kathy, I'm not sure if she says her name Hochul or Hochul. There's an agreement there to increase housing supply, promoting affordability, strengthening protections for renters and homeowners. So one of the big things was increasing housing supply. I don't think there's anybody that's going to argue with that one, that we all see that that's something that needs to happen. Affordability and accessibility to homes. I think everybody agrees that that also is something that really needs to happen. And then the other one that was on here was combating bias and discrimination. And I think some of those conversations have started with, like, are appraisals biased in any way? How do you make sure that if you're using AI in your process, that there isn't a bias built in? Some of those conversations have already started to happen. So any thoughts on any of those things?
I don't think any of those things, to be perfectly honest, are really on the ground issues that we as lenders have. We've been through 2 years of fun, for lack of better term. I think anybody who has bias built into their system, has discrimination built into their system, or has the ability for it at this point, after taking the last 2 years to really iron out the kinks, systematize things. Again, I don't know where you are because you're obviously not going to be in that revenue growth generating, activity, but that's what politicians need to say. They need to focus on those things. They need to say that we're going to combat it out of the marketplace, and it should be combated out of the marketplace. I just don't think it's really for your IMB space so much.
Yeah. Yeah. There's a different term or a different definition according to Kelly Fun. That now that's funny. Her interpretation of fun, I think, is probably different than yours. I don't know. I mean, there are good things that come out of times like what,
Fun with
yeah, yeah, good things that come out of times like what we faced. I do think that when some of these articles come out, I would have to say, they're things that the general public just doesn't understand in the same way that we do when you're in it all day long, every day. And so I think sometimes when we read some of these articles and everything, it's kind of like, well, duh. But then again, I hear people, in my community talking, and it's always interesting because I feel like they know so little about what really goes on and what the struggles really are. Yeah. Yeah. And Kelly, I agree with you completely. If you don't laugh, you'll cry. So we always want to end things on a note that is happy. The family that we've created here, I think with our lender membership, everybody is willing to help everyone else. And that's kind of a core of who we are and what we want to do. Jared, we're actually a minute over time. I just looked at my clock. Like I said before, it goes so fast. It's been such a pleasure just having you on and just having a great conversation with somebody today. Cannot wait to see you in Denver. And thank you so much for doing this with us. It was our pleasure. Please come back anytime you want to.
Yeah, it was fun. If you want to do it for 32 minutes next time, let me know.
Sounds great. Thanks so much, Jared. Thanks for joining us today, everyone. And if you're thinking about Denver at all, please talk to us. We would love to have you there. Appreciate y'all. Have a great week.
Bye.